Hello, my lovely students at home. Welcome to St. Charles College online lesson. I'm Mrs. Obi-Kate from Economics Department. The topic is Element of National Income. Before we go into the lesson proper, I would like to make you to understand that by the end of this lesson, you'll be able to 1. Say the meaning of national income. 2. Enumerate 5 concepts of national income. 3. Explain 3 concepts of national income. And then compute national income using income method. Now, what is national income? National income is estimated monetary value of all goods and services produced in the country and the total income earned in a given country over a period of time, usually a year. Then, we have national income concepts. That is, by concepts, I mean those things that will help you to understand what actually we mean by national income. And what are these concepts? 1. Disposable income, gross domestic product, gross national product, net national product, net domestic product, personal income, and income per capita. Let us explain these concepts. Then, disposable income. The word disposable, you all students, you know what we mean by disposable. But under the economics concept, we don't mean what you throw into the dustbin. No. Now listen for you to get what we mean by disposable income. Disposable income is part of income left after personal income tax is deducted from income. That is disposable income. Personal income is the earning of an individual and the other factors of production in monetary terms for participating in production of goods and services. If I will draw you back to factors of production, you know what we mean by them. You have land, capital, entrepreneur, and labor. So the services of these factors of production is what we mean. Then per capita income, in bracket we call it PCI. It is the average of income per head. It is obtained by dividing total income of a country by total population of a country. Simply, it means what each citizen of a country is entitled to receive from the income of the nation. Then, we have gross domestic product. It is the total monetary value of all goods and services produced in a country within a period of 1 year by all the residents of a country, regardless of being a citizen or foreigner. It excludes the earnings of citizens or their investment abroad. In calculating GDP, no allowance is made for depreciation. Gross national product, in abbreviation, GNP. It is the total monetary value of goods and services produced by citizens of a country, both home and abroad. It excludes the earnings of foreigners or their investments in the country. No allowance is made for depreciation. Now, I want to explain something here. We have gross national product and the gross domestic product. So the difference between the two is that the gross domestic product concerns about people resident in a particular country, whether they are the citizens of that country or not. But when you talk of GNP, that is a gross national product, it concerns the income of the citizens and their earnings abroad. That national debt makes it to be for the citizens of a particular nation. Then we have net domestic product. It is the total monetary value of goods and services produced by all the residents of a country and the earnings from their investments, whether citizens or foreigners, after allowances have been made for depreciation. We have net national product or national income. It is the total monetary value of all goods and services produced by all the citizens of a country and the income from their investments, whether at home or abroad, after allowances have been made for depreciation. Now, what is this depreciation? We all know that depreciation means loss in value. Its opposite is appreciation. Sometimes you hear Naira is appreciating or Naira is depreciating. So that depreciation also is being used for assets, mainly fixed assets. It means wear and tear of assets. In a simple language, loss in the value of assets. So in industries, most assets depreciate as due to their daily use. For instance, motor vehicles, buildings, tools, and so on and so forth. That is why sometimes when you buy a car, and after using that car for some years, if you want to sell that car, you cannot not sell it at the price at which you bought the car. Rather, you have to sell it far below the price at which the car was purchased. So that is depreciation. Then, national income is being measured or being computed. We have three methods for computing national income. The first one is a output method or value-added technique or approach. The second one, income or factor method approach. And finally, expenditure method approach. Now let us explain ways of measuring this national income. The first one we have here is a output or product method or value-added technique or approach. This method measures total value of all goods and services produced in a country by individuals, firms, and governments in a year. To avoid double counting, only final products or value added should be considered. What do we mean by double counting? Double counting means a situation where we have a particular value of a product being repeated in two places. That is what we call double counting in measuring national income. So to avoid that, only value added is being used to compute it. Then the next one is income or factor method approach. This measures the earnings of all the factors in a particular period. Transfer income or gift to beggars and aged people should be excluded. Why should we exclude such income? The reason is because if I, for instance, as a civil servant, I received my salary, then from that my salary, I try to help my aged mother at home by giving her some pocket money. If on counting or on computing national income, if that money which I gave her, she herself records it as her income, and I myself, I also record it as my income, it is going to bring false statistics of national income, because that money has to come under me as my income. If it repeats under my income and the income of my mother, the figure will be wrong. Then we have formula for calculating national income by income method, which is Y is equals to W plus R plus I plus P plus D, then plus IBT. Now, what do we mean by this? Y stands for income. W stands for wages. R stands for rent. I, interest. P, profit. And D, depreciation. Then IBTC means what? Income, indirect business tax. Indirect business tax. Now, for you to compute income method, what it means is that you have to add all the income of the government, the firms, or individuals, as the case may be, based on the figures given to you. Then you pick all the figures that are income, then add them up. It will give you national income. Then the last one is expenditure method. This method calculates national income by adding up expenditure and the consumption and investments made by individuals, firms, and government during a year. In order to avoid double counting, expenses on goods and services used in production are excluded. The formula for calculating expenditure method is Y is equals to C plus I plus G plus bracket X minus M. And what do we mean by this? Y stands for income. C, private consumption expenses. I, investment expenditure. G, government expenditure. M, exports. X, exports. M, imports. So to get X minus M is a net exports. So When you are computing national income using this method, it is very simple. Add all the expenses that are being incurred in a particular year by government, firms, and the individuals. Why do we mention these sectors of economy? Because these three firm, individual, and government gives you complete sector of an economy. It revolves round. Once you get the expenditure of the government, the expenditure of individuals, and the expenditure of the firms, you have gotten national income. And this is straightforward. If you want to know your income, assuming you went to the market, you made some purchases, and back home, you were confused. How did I spend this money? For you to know the actual money that you have, sit down, add up your expenses. That your expenses must be equal to your income. There is no way your income should be more than your expenses. And there is no way your expenses should be more than your income. So that is why, if you want to measure national income, use expenditure method. Get the expenses of the government, the firms, and the government. You get the national income. Then we have problems of calculating or computing national income. The first one is problem of double counting. Yes, I have mentioned this before. Double counting, a situation whereby one figure appears twice. And in a situation like that, it gives you wrong estimate or wrong statistic or wrong figure of national income. Then we have predominant substance economy. That is where people produce for self-consumption. Sometimes they do not offer or present their income for calculation. Then we have inadequate data, implying both the government, the firms, do not produce complete data of their income, thereby giving false figure. Different principles of depreciation. Yes, I have explained to you what we mean by depreciation. So most companies have their own ways of measuring depreciation. So that presents problem in calculating national income. Then illegal transaction. So there are some transactions which people do, and through that illegal transactions, they earn income. But such transactions will not be, people may find it difficult to present it for public consumption. Something like when people deal on hard drug, their income, the person will not be proud to say, yes, I got this money from here. Or a prostitute, or an armed robber, and so on and so forth. So income from some of these illegal transactions is a problem in calculating national income. Changes in the value of money, price changes, and problem of assessment of net income from abroad. Then importance or uses of national income estimates. Why should you worry or bother having these national income figures? Number one, it is used to determine economic situation of a country. That is, whether the country is poor or rich. For a sectional comparison, when you want to compare agricultural sector, educational sector, health sector, and so on and so forth. Then economic planning, it helps those in planning of the economy of their country on a way forward. Then comparison of economic growth among nations. That national income figure we say is Nigeria richer than Ghana, is Ghana richer than Sierra Leone, is United Kingdom richer than China, and so on and so forth. Then for future forecast, Based on the figure of the national income, then the economic forecast can say whether a nation will face economic problems or not. Then, to measure the standard of living, are the citizens of the country living comfortably or not? It reveals income distribution. It is a useful guide for investors. When a foreigner, wants to invest in their country, Nigeria, that foreigner will first of all demand for national income of Nigeria, the national income figure, to know whether such figure will give him the go ahead or not. Then it helps to estimate per capita income. Per capita income means nothing but income per each citizen of a country. So if what each citizen of a country goes home with will be able to take care of him or her, then that nation is rich or poor. Then it determines the regional contributions and it influences foreign aid. Limitations of the uses of national income. The first one is different approaches to measurement of national income. Changes in the value of money. Value of money is not constant. It changes from time to time. So, as a result of that change in the value of money, it affects national income. Just as we are now in COVID-19 pandemic, you know that our country, Nigeria, is facing a lot of economic problems. And as a result, the value of money is being affected. Then, it does not reveal income distribution in a country. There is also changes in the population and the problems of population statistics. Differences in the structure of production, differences in working conditions, and differences in value of money. Then, what are the factors that determine national income of a country? Number one is availability of natural resources. When natural resources are available in a country, the income of that nation ought to be rich. For example, Nigeria is being endowed with so many natural resources. We have crude oil, we have gold, we have coal, and so on and so forth. Then level of technology, industrial development, working population, economic situation, nature of factors of production, and finally, political situations. So, from what we have learned from national income, we have seen what national income is, that it means the monetary value of goods and services produced in a country within a given period, usually 1 year. That is national income. We have methods, 3 methods: income method, expenditure method, and value added approach. These are the 3 methods for measuring national income. Then we have problems, the importances, the uses, the limitations. And also we have the concepts of national income. So having learned all this, I'm giving you assignments which you are going to do. 1, define national income. 2, mention the 5 concepts of national income. Then finally, explain 3 concepts of national income. Hello students, we have come to the end of today's lesson. Make sure you do the assignment. Do the assignment and submit the assignment in my WhatsApp contact of St. Charles College. 08026729850. Please make sure you do the assignment. Thank you and remain blessed.